So when we start to look at the Camarilla pivot points, one of the things the Camarilla pivot points really helps you determine is your expectation of range. It's actually one of my favorite parts. Camarillas utilize what's called the 2-day pivot relationship. So we look at basically the distance between our second levels, S2 and R2, and see if that range is wider or narrower than the previous day. Now, this doesn't really affect ATR or how far we think the stock can move. It just gives us an idea of whether we expect to chop or break out. If a stock has very compressed cams, especially in relationship to the previous day, then our expectation is to play a breakout. We're going to hopefully have it open above R4 or below S4, kind of like Tesla today, extremely narrow cams compared to yesterday, right? We're going to expect it, and it did open under R4 as well, or S4 as well. We're going to have it open in these breakout ranges, and then we will play the movement away from the range since it's so tight. But on days where that relationship is significantly wider, right, then we're going to be looking to stay inside and chop. This is one of the most beneficial parts to these cams, is because imagine going into your day already having the expectation that the price isn't going to go anywhere, right? Especially as a momentum trader. Imagine sitting down and looking at a ticker, doing the 2-day relationship and saying, you know what, we broke out yesterday. We had tight cams yesterday. Today our cams are very wide. We're probably going to stay inside. Imagine how differently that will change your perspective in an instant. No longer are you worried about playing a breakout or trying to squeeze every dollar to the top side. Rather, you're going to get whatever you can get out of that ticker until you get to the edge, and then likely flip and play the other direction. Having this concept of where to look for trades is way beyond just where I want to enter. It can actually formulate your entire day's plan, right? If you're opening up in mid-range and you're not near an R3 or an S3, you don't even need to worry about trading that ticker yet. It needs to get to an edge for you to start trading it. So you need to let it rally to R3 or sell to S3, and then you can start playing it. This will allow you to wean down your watch list down to 1 or 2 tickers, because even with all the Apples, the Teslas, and the AMDs and everything, only 1 or 2 of them will be in the right place. Right? Now inside versus outside, right, doesn't mean direction. It just means inside or outside, right? If we have wide cams, so we're expecting to stay inside, right? It doesn't mean we're picking a direction, right? It just means this is where we expect to stay. So an outside day, right, is the opposite, right? We have an inside value range and we're expecting to go outside. Now, this doesn't mean we only break up. We could actually open outside, go completely through the range, and come out the bottom, right? It just means outside, right? We're not expecting to close anywhere inside of this little area in here, right? We're expecting to come out here and either be out here, right, or be out here, right? But we're not expecting to be in here, right? Imagine how handy that can be. You're thinking about playing a reversal, right? Are you going to reverse R3? Are you going to reverse R4? You know what? The cams compared to the previous day are extremely tight today. I actually think we could break out. We have a bearish order book. I think we could break out. I'm not going to play this reversal, right? Or we have tight ranges. We have a bullish order book, and it looks like we're holding S3. I'm going to buy S3, right, and allow it to break out. I'm talking a lot about the where today, right? But remember my previous, what my quote that I opened up with, right? Where, when, and how, right? So this is so using a limit order in that fashion for me is kind of the opposite of momentum trading, right? I think momentum alone is difficult because it often ignores range, but I think range alone is often also difficult because it ignores momentum. Right? If there's a stock at the bottom of the range and we are selling heavily towards that stock, and there's more orders, if there's an order at the bottom of the range and we're selling heavily towards that order, price tends to move to size. And if there's more orders below that, then I'm not getting in front of that freight train, right? I'm gonna let it rip through those orders and then see what happens. Right? If we rip through the orders and then we buy, hold that area, it becomes held, and then we make new highs. Now we're talking, right? I've seen participants on the book defend an area, right? And then I've seen a response to that I can play. And it gives me a really clean area of where I want to stop out, right? I saw it test this area. I saw it hold this area. So now I know where I'm right and wrong, right? If I'm wrong, I'm going to be wrong if that order loses, right? So I'll enter and put my stop behind that order. If I get flushed, no big deal. If it holds again, I'll try again. Here's a little example. This is on the SPY from a little while ago. And I want you to just see here, it was like May of last year, I think. You can see here, look how we bought S3, but because of the tight range, look how we broke out. Look at the wider range, that was the next day. Look how we stayed inside the range, right? And then on the next day, R4, we had a tight range again, look how we broke out. Right, so this is a really, if you go back through the SPY and look through the SPY, you will see this happens the vast majority of days. It fits this profile. But not just SPY, not just Qs. Microsoft, Apple, AMD, Tesla, tickers. The reason why these work like this, right, and you just got to take my word from this, because I can't provide you a document on this. I can just provide you a little bit of insider info here, right? I do have buddies that work on the NYSE, right? I've been fortunate enough to get to go on in the NYSE almost a half a dozen times at this point. Peter Tuckman is a good friend of mine. His son's a good friend of mine. I've made a couple of buddies over at Citadel who are really fun guys, right? And I know for a fact that Citadel uses Camarilla pivots for a majority of their DMM movement algorithmically. Right, Citadel is currently representing around 30% of the total market traffic as far as market making goes. So if you wonder why these things work so well, it's because they're using them, right? The reason we sell in these areas, or the reason we buy in these areas, are not fancy. We're going to buy and sell here because this is where they are going to buy and sell, right? The only thing we need to do is identify that area and then wait and see it happen, right? If we're seeing an area where we expect it to sell, and then the price hits that area and we see selling, right? This is like being a surfer and sitting where you expect to see a wave, right? You're sitting there on your board, you expect to see a wave, you see the wave, you get on the wave, right? So now that you know where to look for specific price action, this makes it so much easier because you can just sit and wait and say, if it comes into my range and I start to see selling, I'm going to sell, right? And you will find that this correlative activity is much more predictable than any breakout ever will be, right? The stock market does the same thing over and over and over and over again until it doesn't, right? Which inherently, just by saying the words, letting them roll out of your mouth, right? You have to know that you're going to statistically do better in that direction.
Hello, market alchemists, and thank you for watching this video. We hope you enjoyed it. Please make sure to watch the next episode. And before doing so, like and subscribe.